You've probably seen people turn a few $1,000s into hundreds of thousands of dollars by yeeting into cryptocurrencies with super low market caps that end up doing 100x. You've probably also seen people make insane amounts of money by analyzing the charts and trading using something called technical analysis. While it might be okay to have a small portion of your portfolio in a degen account where the cryptos you invest in can either do a 50x or bust, the wiser decision would be to have a much larger portion of your portfolio in an account that uses technical analysis to get in and out of trades. In fact, your ability to use technical analysis to make good trading decisions could be what separates you from making insane amounts of money and losing everything in the markets. And technical analysis isn't just for crypto. If you know technical analysis, you could trade any market, be it crypto, stocks, Forex, or more. Technical analysis is a crucial skill when it comes to trading, and it's something that you cannot do without. If you don't understand technical analysis, or if you don't know how to use it correctly, then that is likely a huge reason why you are either currently losing money as a trader or not able to make consistent profits over time. And that's why in today's video, I'm going to show you everything you need to know about technical analysis. We're going to start from the very basics, starting out going over what a candlestick is, and then you're going to go step by step, learning about support and resistance, trend lines, indicators, entries, stops, profit targets, and more. You will learn everything you need to know about technical analysis as I'm putting everything I've learned about TA over my 7 years of trading into one video. Now, since you're getting all of this for free, if you could do me a favor and smash that like button and subscribe to the channel to help out with the YouTube algorithm, that would help out tremendously. And make sure to drop a comment because I'm sending out 100 Dogecoins to the comment that I like the most. Without further ado, let's share the disclaimer and get started with the presentation. Jumping in, what even is technical analysis? Technical analysis is the study of historic price movements in order to make accurate decisions of what the market may do next. This is a chart of Bitcoin. Charts are simply visual representations of price. Each one of these bars is called a candlestick. Candlesticks move up when the price of the asset moves up and down when the price moves down. Under the chart are a couple of indicators, and even indicators are based around price. So, because everything is based on the price and prices are displayed as candlesticks, the first thing we're going to learn about is a candlestick chart. Here you could see a chart for the cryptocurrency Bitcoin alongside a Forex chart plotting out USD against the Japanese yen. And below that, we have a stock chart of Tesla and a commodity chart of gold. You could see that every market uses candlesticks as the foundation for technical analysis. So it doesn't matter what you trade, you need to know how to read candlestick charts. And before you could understand an entire candlestick chart, you need to understand an individual candlestick. So here are two candlesticks. Now, each candlestick represents the price movement that occurred during a certain period of time, depending on the time frame that you're on. So if you're on the weekly chart, each candle represents the price action that occurred from the start of the week to the end of the week. If you're on the daily chart, each candle represents the price action that occurred from the start of the day to the end of the day. If you're on the hourly chart, each candle represents the price action that occurred from the start of each hour to the end of each hour, and so on and so forth. Now, each candle has a body, which you can see here, and wicks above and below the body. Each candle also has an open, a close, a high, and a low. These areas are self-explanatory. The open is where the candle opens. So for this candle, it opened right here. And the close is where the candle closes. And in this case, the candle closed right here. The high is the highest price the candle reached during whatever time frame you're on. So this is the absolute high right there. And the low is the lowest price that the candle reached depending on whatever time frame you're on. So in this case, the low is down here at the bottom of the wick. And the color of the candle depends on whether the price is higher or lower than the candle open. If this was on the daily chart, this candle would open and it would close 24 hours later right here. And same thing for this. If this was on a 24-hour chart, it would open right here and then close right here 24 hours later. And that's because if the closing price is higher than the opening price, then the candle is green. And if the closing price is lower than the opening price, then the candle is red. And you could also change the colors to suit your preferences. And personally, I like using blue and white because I find the red and green to be a little bit too much for me. Now, if there are wicks above or below the candle, then that means during that time frame, the price visited that particular price, but then came back down before the candle closed if the wick is above the body, or it came up if the wick is below the body. So for this candle here, you could say that it opened right here, and during this particular time period, the price did come up to this level, but eventually it fell all the way down here before closing right here. And for this one, it opened right here, and during this particular time frame, it came down and reached this low, and it came all the way up and reached this high before coming back down and closing on the time frame right here. And all of these concepts are the same no matter what time frame you're on. So if you're on the 1 hour chart, then this candle might open at 1 o'clock p.m. And then during that time period between 1 and 2, maybe it came down here and it came all the way up here. But then by the time 2 o'clock p.m. came around, it closed right here. So that would be a 1 hour time frame and a 1 hour candlestick. And the wicks simply mean that within that hour, the price moved up here and down here. And eventually, though, the price did close right there. And the same thing for this candle, except it's in the reverse. So maybe this candle opened here at 1 p.m. and then it ended up closing here at 2 p.m. But in between that time, it did reach a high and a low right here and right there. So now you know what each individual candle represents. And so what we as traders do is look at the charts, which are comprised of these individual candles, and we use them to help us interpret what the price is likely to do next. We do this by identifying certain types of candlesticks, different trends, areas of interest, and other components that we could put together to form a trading thesis and put on a trade. So let's go into the charts and look at some live examples. Here we have the Bitcoin chart on the daily time frame. So each of these candles on this chart represents 24 hours or 1 day of price action. A green candle represents a day where the price closed at a price higher than where it opened. And a red candle represents a day where the price closed at a price lower than where it opened. So this candle right here opened right here. The price then moved between this low and this high and eventually came down and closed the day right here. And so now let's look at how we could use this knowledge to make trading decisions. To do this, the first thing you need to look for is what direction the market is trending. And so let's get into that now. And so there are 3 types of trends in markets. There's the uptrend, there's the downtrend, and there's the sideways or ranging trending markets. So take a look at this chart. Would you say that this is in an uptrend, a downtrend, or a sideways trend? Hopefully you said this was in an uptrend. You could tell it's in an uptrend because the chart is consistently making higher highs and higher lows. The price is, generally speaking, moving higher as time goes on. Now, the reason we look for trends is because it gives us more accuracy in our trades. You've probably heard the saying, the trend is your friend. And it's a good saying. Most beginners gravitate towards trading with the trend, and it's a smart thing to do because it gives you a higher probability of being right in your trades. It's always way easier to ride an existing trend compared to trying to call the very top or the very bottom of a trend. And that's why it's a good thing to trade in the same direction as the trend. So with knowing that, and with this market being in an uptrend, what direction would you like to trade? Hopefully you said up or that you want to buy because that would mean that you're trading in the same direction as the trend. Now, I see new traders get confused all the time when it comes to trend because the price doesn't give you that super clean chart where it's really obvious. Looking at this chart, for example, if you were only to look at this area, you might get confused or start questioning if we're really in an uptrend or not. So I'm going to give you a very clear, objective rule that you could use to determine if we're in an uptrend or not. In trending markets, we have what we call impulsive moves. In uptrends, the impulsive move is the move to the upside that creates new highs. On this chart, we have these impulsive moves here. After each impulsive move, the market takes a breather. We call those pullbacks. These are our pullbacks on this chart. After each pullback, we have another impulsive move up. To create an objective rule that you could use to identify a trend, you could say that the uptrend is intact unless the low of the pullback gets broken. On this chart, the lows of each pullback are these areas here. So we have this impulsive move that created a new high, and this is the low of the previous pullback. This is the next impulsive move up, and this is the low of the previous pullback. This is the next impulsive move up, and this is a low of the previous pullback, and so on and so forth. Now, notice how the lowest low of each pullback was not broken. This means that the uptrend was intact the entire time. As long as the price remains above the low of the pullback, we want to be looking for buying opportunities. What we do not want to see is the price breaking below the low of the pullback. If that happens, the uptrend will be broken and you have to switch your strategy to adapt to the market. And this is how you can objectively identify whether the market is trending up. And you can do the same thing for if it's trending down in the opposite direction, which we're going to be going over in just a second. The reason we want to have this information is because we want to be trading alongside the trend of any given market. In this case, you want to be buying or going long in this market. You do not want to be shorting the market here, trying to make money when the market goes down, because the probability of the market going up is a lot higher than the probability of the market going down. And you always want to trade with the probabilities in your favor. If the price went below the low of the previous pullback, then you could start to look for selling opportunities on any bounces up. But really, it's only when the market is in a clear downtrend that you should look to open up short trades, which simply means that you are making a bet that the price will go down. So let's go ahead and look at a downtrending market now. So if we're looking for higher highs and higher lows in an uptrend, what do you think we look for in downtrends? It's the total opposite, right? We look for lower lows and lower highs. Here you could see the lower highs and the lower lows very easily. Just like how in uptrends we have impulse moves followed by pullbacks, you have the same thing in downtrends. What we don't want to see is the price close above the high of the previous pullback in a downtrend. If that happens, then that's a possible reversal. If that doesn't happen, then the downtrend remains intact and we should be looking for selling opportunities as long as the market continues heading in the downward direction. Here we have the impulse moves down that break the previous lows, and we have the pullbacks. None of the pullbacks broke above the previous highs, so the downtrend was intact the entire time. But what if the market does what it normally does and paints a more confusing picture? Take a look at this chart. You could see that it's in a downtrend, but it could be extremely confusing unless you have objective rules in place. Additionally, there's also a secret that you need to know when it comes to trading trends, which you're about to see happen in this chart. And this is something you won't find on other channels. So first, let's go over this chart using the knowledge that you know. We have the impulse moves down in yellow and the pullbacks in blue. The first pullback did not break the previous high, so the downtrend is intact. The second pullback did not break the previous high, so the downtrend is still intact. The third pullback at first only created an equal high, so the downtrend remains intact. However, you could see that the price did eventually break above the previous highs. Now, as soon as the price closes above the highs of the previous pullback, that's supposed to mean we're now in an uptrend. Well, not necessarily. Firstly, remember that in order to be in an uptrend, we need a higher high and a higher low. There is no higher low here. Also, and here's a secret, so pay attention, Smart money knows that people who don't understand technical analysis FOMO in at the tops. And they know that people might wait until previous tops are taken because they are under the false pretense that once a previous top is broken, then that makes it safer to buy. Along with that, smart money knows that people who are short the market put their stop losses right above the previous highs. So this right here is known as many names: a failed breakout, a stop loss hunt, a run on liquidity, and other things. So sometimes in downtrends, smart money will push the price up to just above the previous tops before crashing it back down again. What you need to know is that if the price jumps up above the previous high and then immediately fails and falls back down beneath it, that was most likely a stop loss hunt by smart money, and the original trend, which in this case is a downtrend, will most likely continue. And this is actually such a powerful concept that you could even see it on the Bitcoin weekly chart, where the price closed above the previous all-time highs and then quickly moved back underneath of it, and that marked the top of the cycle. Once we broke all-time highs, everyone thought we were going to $100,000. But when we had that run on liquidity on the weekly time frame, that was a major clue that the top was in. Remember, this never happened before the entire market cycle, so it only happened at the actual top. And now guys, if you're enjoying this presentation and the alpha that you're getting, if you haven't already, do me a favor and smash that like button, and let's get this video to at least 100 likes. So now that you understand candlesticks and trends, let's go into finding areas of interest using support and resistance. Support and resistance are simply areas in the market where the price has previously bounced or rejected off of. Once the price bounces or rejects from a certain level, that increases the probability that it will bounce or reject from that level again. Support is an area in the market where the price is likely to bounce up from or be supported by. You could see that the price continually bounced off of the support every time it hit that zone. Resistance is an area in the market where the price is likely to bounce down or get rejected down from. You could see that the price came up to the resistance here and got rejected. Then it tried again and got rejected again, and even attempted a third time only to get rejected again. So let's dive into some charts and talk about support and resistance and how they could help us make better trading decisions. Here we have a chart. It's in a clear uptrend, and I marked out the impulsive moves up and the pullbacks. And I've also marked out the swing lows. None of the lows were broken, so the uptrend was intact this entire time. Now on this chart, what I did was I marked out the previous highs. Now resistance levels are created from previous highs. So if the market is moving sideways, you could assume that the price will get rejected off of the resistance. However, by definition, if the market is in an uptrend, then the resistances get broken and the price makes new highs. Once the resistance gets broken, what typically happens is that the resistance flips into support. So if you take a look at what happened every time the price broke through the resistance on this chart, during each pullback, the price always came back to the previous resistance and used that as support. And this is how you could use support and resistance as entry points in a trend continuation strategy. So now let's look at this in a downtrend. You can see here is a clear downtrend making lower lows and lower highs. We have the impulse moves down and the pullbacks. I went ahead and marked out the previous highs in this chart, and none of them were broken except for this one right here. But you could see that it was immediately rejected and shot the price back down, just like what we talked about earlier. Once it got rejected, the price continued the downtrend. And here you could see all of the times the previous support flipped into resistance. So what are we doing here? Number one, we're assuming that the trend will continue. And we are seeing that the trend is in a downtrend. Then we're looking at the previous supports, and once they are broken, to be areas of interest to look for short trades or to sell so that we continue to trade with the trend. So the important thing here is that you understand that there are uptrends and downtrends, and that in uptrends, the price breaks through the resistance, while in downtrends, the price breaks through the supports. And in uptrends, once the resistance gets broken, that then turns into an area of interest where you should look for longing opportunities during pullbacks. And an important thing to know is that just because we have support resistance flips, or SR flips for short, it doesn't mean that you should automatically long the SR flip in an uptrend or automatically short the SR flip in a downtrend. You have to look for longing opportunities once the price enters these areas of interest. And we'll be going over how to do exactly that later in this video. Just like how you shouldn't automatically long a flip of resistance into support in an uptrend, you shouldn't automatically short a flip of support into resistance in a downtrend. You need to wait until the price reaches these areas of interest and then look for trading opportunities. And if you have any trouble understanding the general concept of support and resistance flips, just rewatch this section again. Also, I'll have other videos going more in depth on support and resistance as well. You now know that charts are made up of candlesticks, and you know that each candlestick gives you vital information about the price, and you know that as price continues moving higher, printing higher highs and higher lows, then that is an uptrending market. And you know that as the price continues to move lower, printing lower highs and lower lows, that is a downtrending market. Also, you know that as resistances get broken in uptrending markets, they become areas of interest to look for longing opportunities. And you know that as supports get broken in downtrending markets, they become areas of interest to look for shorting opportunities. And you're doing all of this because you're wanting to trade with the trend. So now let's keep on going and talk about indicators. Indicators are formulas or equations that take into account current and past price action to create lines, histograms, and other tools on the chart that you could use to help predict future price action. You could also use indicators as objective data points that you use in your trading strategies to help provide clarity and consistency. Trading indicators could help to provide clarity on market conditions, help identify market trends, areas of value, entry points, exit points, and more. All you need to do to get indicators to show up on your chart is to just click the indicators button on TradingView, and this box pops up right here. And this is where you could type in what you want or scroll and look for different indicators. Now, these are just a few of the indicators available. As you can see, there are countless, and you could experiment with as many as you want to see which ones that you like the best. In this video, I'm going to show you my favorite indicators, how I set them up, and how I use them. I typically use 4 indicators while trading. They're the Fibonacci, the Relative Strength Index, or RSI, the Stochastic RSI, and the MACD. Starting with the Fibonacci, the reason why I love the Fib is because it's the only indicator that is found everywhere in the universe, and traders apply it to the charts. Typically, traders and mathematicians are the ones that create the formulas and equations that make up the indicator. The Fibonacci is different because no one created the Fibonacci. It was simply discovered to be a natural phenomena. And the Fibonacci is a set of numbers that, when applied to the charts, can be used to help with your trading and discover areas of interest and a lot more. The Fibonacci numbers are 38.2, 50, 61.8, and 78.6. The most important Fibonacci number is the 61.8. And this isn't the most important by just a little. This is technically the Fibonacci number, and it's often referred to as the golden ratio. So whenever the price comes down to the 61.8, I always look for trade setups. Let me show you some examples, and maybe your mind will explode the same way that mine did when I first started seeing this. Here we have the Bitcoin chart, and you could see that it was in an insanely strong uptrend, and it was hardly going down until basically right here. Now, if you take the Fib from the start of the move and you bring it all the way up to the top of the move, you could see that the 61.8 is right here. And this is exactly where the price came all the way down to and hit it pinpoint before it ended up skyrocketing back up again. And so that was Bitcoin. And we have the same thing that happened on the Ethereum chart. Price was moving up super aggressively. And if you took the Fib from the low of the start of this huge move up, and you took it from the low to the high, you can see the 61.8 is right there, and the price came exactly down, literally wicked down into it before popping back up and continuing the uptrend. This is something that I see happen all of the time, and it's the reason why the Fibonacci is my favorite indicator. Even on lower market cap coins like this one, you could see taking the Fib from the very, very start of this huge uptrend. You start it right here and you take it all the way to the very, very top. Here's the 61.8. And once again, the price came all the way down and it wicked down into the 61.8. This means that it only stayed there for a very short amount of time. And if you got in at the golden ratio at the 61.8, you would be getting in at the bottom of this trend while we're in a very powerful uptrend. So you'd be getting in at the very bottom, which is the very best spot that you want to be buying. And yes, this even works on stable coins like XRP. So if you take the fib from the bottom of this giant move up all the way to the top, here's the 61.8, you could see that XRP came down to the 61.8 exactly just like the other ones and started its uptrend again, or it started to move up from the golden ratio once more. So now you might think, okay, so always buy at the 61.8. And while that does actually work a lot of the times, there are times where it doesn't. So you could take a look at this chart where the price did come down and bounce off of the 61.8 originally, but then it did end up falling down and dropping below it. And there are times where the price never even comes down to the 61.8. So you could see this example. We had this huge move up. The Fibonacci starts at the beginning of the move up, ends at the top. Here is the 61.8, and the price actually never reached it. It only reached the 50%. And so the price only had a pullback to the 50% region before having another impulse move up. Just like every other indicator or strategy, nothing is 100% guaranteed in the markets. And if I were to go over every single situation in where you should use the Fibonacci and how you should use it, that would make this video at least 2 hours. If you want to know that information though, I will be making more videos in the future that will cover that topic. However, every day that passes where you don't have the right information to succeed is more time wasted. It's crucial that in life, you treat making money with a sense of urgency because everything that you want to accomplish is going to take you much longer than what you expect. That's why courses and books and actual time doing the thing you're trying to get good at is so important, because that's how you will cut down on the amount of time that it takes you to understand things and for trading become profitable. So if you want to cut down on the time you'll spend learning all the ins and outs of trading, including all of the different situations where you'll use the Fibonacci and how to use it, there is a course available at cryptoelite.com, which is there to help you. So if you're serious about trading and interested in supercharging your learning so that you truly understand the crypto markets, there's a link in the description for you. Now, getting back to the presentation, we just talked about the Fibonacci. The next indicator that I love to use is the relative strength index. The relative strength index is typically called the RSI, and you can find it the same way you find all the other indicators, which is by going to the indicators tab right here and typing in the name, in this case RSI, right here, and then clicking on the indicator. Once you click it, it'll pop up on the bottom of the screen and you could see the name of the indicator here. So what is the RSI? The RSI is what we call a momentum indicator. Momentum indicators are used to help determine the strength of the trend. So if the trend is really strong and the price is going higher and higher, but you see that the RSI is getting lower and lower, that could be a really good clue that the trend is getting weaker and that you might want to take your profits. Now, getting into the RSI, you could see that it starts at 0 and goes to 100. These are the two extreme values of the indicator. And you could also see that there's two lines that go up and down between these values. That, by the way, is known as an oscillator. So if you see two extremes and a line that's fluctuating or oscillating between them, you know that is what is referred to as an oscillator. Typically, when oscillators reach their extremes, that is when they become really important because those areas represent when an asset is either overbought or oversold. The presets for the RSI put the overbought area above 70 and the oversold area below 30. Many people like to change the default RSI settings to 80 and 20 so that when those areas are hit, there's a higher probability of them actually being true instead of false signals. But for this video, we'll keep ours with the standard configurations. The line on the RSI typically looks back 14 bars and it calculates the strength of the move up against the strength of the moves down. If for some reason there was a massive amount of strength in the market that recently pushed the price higher compared to the strength of the previous 14 days, if you're on the daily time frame, then that will likely send the RSI into the overbought territory. And if there's a massive dump in the markets that had a lot more strength to it compared to the previous 14 days, that might send the RSI into the oversold territory. You could see the RSI value right here in purple, and there is also a yellow moving average laid out for you, but honestly, you don't really need that. All that does is smooth out the RSI, but it's the RSI that you're really looking at. You could see in this chart that the RSI went into the overbought area 3 times. Looking at this, you might ask yourself, why didn't the price go down the first 2 times that the RSI went into the overbought area? Firstly, as mentioned before, you cannot rely on any one indicator to always base your trades off of. This goes for any indicator that you might use. You need to use a multidisciplinary approach to bring in multiple things to build a trading thesis. For the RSI, it could remain in overbought or oversold territory for a long time while the crypto is trending hard. For people who don't know any better, this could be confusing. But if you learn how to use the indicator within the greater context of the market and pair it with other things to create your trade, that clarifies every issue that you might have. Some traders like to only look for bullish signals from the RSI when the price is in an uptrend and will only look for bearish signals when the price is in a downtrend. Typically, when the RSI crosses the 30 mark, that is bullish because it's hard for an asset to remain oversold. And when the RSI crosses the 70 mark, that is typically bearish because it's hard for an asset to remain overbought. The true power of the RSI and other momentum indicators, though, is when they have what's known as divergences. An RSI divergence occurs when the price moves in the opposite direction of the RSI. In other words, a chart might display a change in momentum before a corresponding change in price. Look at these 2 points here. You could see that the RSI first topped out right around here. And when it did, the price was right here. And you could see that the RSI eventually went back below 70 before popping back up to above 70 and being in the overbought territory right here. So the second top of the RSI was higher than the first, and the price at the time of the second top of the RSI was higher than where the price was during the first top of the RSI. So that is telling us that the momentum of both the price action and the RSI is extremely strong and that there is a very strong uptrending market. Now take a look at this chart and take a look at the difference between the second RSI top and the third RSI top. The second RSI top was right here. The RSI then dropped below 70 before making its way back up above 70 again, back into the overbought territory, and it topped out right here. So this RSI top number 3 is lower than the RSI top number 2. So the RSI top number 3 is lower than the RSI top number 2, and this is a momentum indicator. So that means that the momentum is getting weaker. But what's happening with the price? The price is actually higher at the time of RSI number 3 compared to RSI number 2. When this happens, this right here is what's known as a bearish divergence. It's telling you that the momentum is weakening even though the price is going up. And right after that happened, the price started going down, even though there was this huge uptrend previously. So just so you understand, a bearish divergence occurs when the RSI creates an overbought reading, such as here, then dips back below the overbought territory or the overbought level, which in this case is 70, and then rises back above it again and puts in a lower high, while at the same time, the price puts in a higher high. These divergences are some of the most powerful signals that you could use in your trading. Personally, they hold a lot of weight in my trading decisions when I see them on the chart. So if a bearish divergence is when the RSI prints a lower high in the overbought territory while the price puts in a higher high, what do you think a bullish divergence is? If you said that a bullish divergence is when the RSI prints a higher low while the price prints a lower low, you'd be right. Here you could see that the price and the RSI came down, and the price created the low right here, and the RSI created the low right here in the oversold territory. Then the RSI and the price went up before coming back down again, right there for the price and right here for the RSI. This time, the price went lower than the previous low, where it was when the RSI first dipped into the oversold territory. However, the RSI printed a higher low compared to where it was during the first low of the RSI. This is telling you that the momentum of the downtrend is weakening and that there might be some hidden buying pressure that is just waiting to explode the price up. And of course, you can see that is exactly what happened with the price moving up. So if you see a bullish or bearish divergence on the RSI, take note and treat it with respect because they do not come around very often. This is especially true on the higher time frames. And if you see them along with candlestick formations, or if they are occurring at major levels of support or resistance, that is even better. And there are a few more subtle things about the RSI that I'll teach you about in other videos, such as the hidden bullish and hidden bearish divergences, what it means if you see the divergence happening and yet the price does not act the way you think it should, and what it means when the RSI hits the overbought or oversold areas, yet continues to move either up or down. And if you want to get first access to those videos, they will be available at cryptoelite.com. So if you want to know all the ins and outs of the RSI and how to use it in every situation, you could find more info at cryptoelite.com. For now, though, let's go into the next indicator, which is the stochastic RSI. Here, I put the stochastic RSI, or what I like to call this, it's the Stoch RSI. It's just easier for me. I put that up on the screen right below the standard relative strength index. So this is the stochastic RSI, and this is the relative strength index. Just like the regular RSI, the Stoch RSI also ranges between 0 and 100 and has a line that oscillates up and down within the range. And that means that it is also an oscillating indicator. And it also has overbought and oversold regions, with the overbought being above 80 and the oversold being below 20. Now, the standard RSI looks at the last 14 bars of the price in order to come up with the value. The stochastic RSI looks at the last 14 values of the RSI itself in order to come up with the stochastic RSI number or value. So if the stochastic RSI is at 0, that means that the RSI is at its lowest level in the last 14 periods, or whatever look-back period that you choose. A reading of 100 on the stochastic RSI means that the regular RSI is at the highest level in the last 14 periods. Just like the RSI itself, just because the stochastic RSI is overbought doesn't necessarily mean that the price will reverse lower. Just like how if it's in the oversold territory, that doesn't mean that the price will reverse higher. Personally, I use this indicator as confluence to provide greater support for my trade thesis and improve the sensitivity of my trades. You could see that there are a lot more swings in the stochastic RSI compared to the standard RSI. That means that it's way more violent and provides a lot more signals, which isn't necessarily a good thing, because the more signals that you have, the more noise or false signals that you might have. And that's why I always pair it with other indicators and, of course, price action itself. And so if I could see that the stochastic RSI is in the oversold area and the standard RSI is also in the oversold area, then that increases my bias that a possible reversal is going to happen. And the same thing applies for if both of them are in the overbought area. Like here, you could see that the regular RSI and the stochastic RSI were both in the overbought area. That would make me a lot more hesitant to buy, and it will help me look for actually shorting opportunities if they present itself, which you could actually see right here. They did, and the price ended up coming down. In fact, I like to drag the Stoch RSI on top of the standard RSI so that it looks like this. Here you could see the two times on the left were both the standard and the Stoch RSI were both in the oversold areas. And that is where the price ended up consolidating from and then eventually moving up from. You could also see where both the indicators were in the overbought territory, which was very close to the high. And after this high was put in, it ended up being a pretty decent pullback, or at least a much bigger pullback compared to any of these other pullbacks that we saw previously. And that's pretty much all you need to know about the stochastic RSI. So let's go into probably my second favorite indicator, the MACD. So here we have the moving average convergence/divergence, which is usually called the MACD for obvious reasons. The MACD is used to help measure price trends, possible reversals, the momentum of trends, and identify market entry points for buying and selling. Just like the RSI, the MACD is also a momentum indicator. If you double click the MACD on TradingView, this box comes up, and this is where you could see the inner workings of the indicator. And there's also a clear baseline at the value of 0, which you could see right there, and that's typically called the 0 line or the baseline on the MACD. The MACD line, which is this blue line right here, is calculated by subtracting the 26-period EMA, or exponential moving average, from the 12-period EMA. The signal line, which is this smoothed out orange line right here, that is the 9-period EMA of the MACD line, as you can see from the 9 in this box right here next to signal smoothing. Here, I put the 12 and the 26 EMAs on the chart itself on top of the price action, with the faster 12 EMA in orange and the slower 26 EMA in blue. When the faster EMA eventually crosses above the slower blue EMA, that is when the MACD line, which is this blue line, crosses above the 0 line on the MACD. And when the faster EMA crosses below the slower EMA, that is when the MACD line, which is the blue line right here, goes into the negative and falls below the 0 line or the baseline. The first signal that most traders learn about when it comes to the MACD is to buy when the MACD line crosses above the signal line, which I circled in green. And they're also told to sell or to short when the MACD line crosses below the signal line, which I circled in red. Crossovers like this should really only be used when they conform to the prevailing trend. If the MACD crosses above its signal line after a brief downside correction within a longer-term uptrend, then it qualifies as a bullish confirmation and the likely continuation of the uptrend. And if the MACD crosses below its signal line following a brief move higher within a longer-term downtrend, then traders would consider that a bearish confirmation. Using the MACD this way could be okay if you combine it with other things like candlestick patterns, chart patterns, support and resistance, and other indicators. But I really don't like using the MACD in this way because moving averages are lagging indicators, meaning that the price happens first and then the moving average prints. So by the time there's a crossover in the MACD, the price has already moved and you missed out on some of the potential gains. I like looking at the histogram and using that instead. The histogram, which are the green and red shaded bars on the MACD indicator, are used to denote how far away the orange signal line is from the blue MACD line. If the MACD line is above the signal line, then the histogram will be above the MACD's 0 line. If the MACD is below its signal line, then the histogram will be below the MACD's 0 line. You could use the MACD's histogram to identify when bullish or bearish momentum is high and for possible overbought and oversold signals. The way how I like to use the MACD is very similar to how I use the RSI, which is that I look for divergences to put on trades. Bullish divergence on the MACD happens when the price of the asset and the MACD histogram both make a low, and then the histogram comes up above the 0 line, falls back down below it. However, the second low of the MACD is higher than the first low of the MACD. And the price also goes lower. However, the second low on the price is lower than the first low on the price. So the MACD makes a higher low while the price makes a lower low. That is what's known as a bullish divergence. And that is showing that the momentum of the move down that the price made is weakening and that there's really not that much momentum driving the price down. And this could actually mean that there's a ton of buying pressure that is about to be unleashed onto the market. And so the way to use the MACD for a bullish divergence is to buy as soon as the histogram prints a lighter red or pink color while still underneath the 0 line. And so that would be right here or right here. And doing that gives you the best possible opportunity for massive gains. On this chart, the bullish divergence on the MACD ended up being the local bottom. If you know how a bullish divergence works on the MACD, you should know how a bearish divergence works. A bearish divergence on the MACD happens when the price of the asset and the MACD histogram both make a high, which you can see right there and right there. And then the MACD histogram moves below the 0 line before moving back above it. and the second high that it creates is lower than the first, while at the same time, the second high of the asset itself is higher than the first. So the price makes a higher high, but the MACD makes a lower high. This is showing that the momentum of the move up that the price made is weakening and that there's still really not that much momentum driving the price up. And this could mean that there is actually a ton of sell pressure that's about to be unleashed onto the market. And the way to use the MACD for a bearish divergence is to sell as soon as the histogram prints a lighter green color while still above the zero line. You could see that the bearish divergence on this chart actually marked the local top. Exactly like the RSI. If you see a bullish or bearish divergence on the MACD, take note and treat it with respect because they don't come around very often. And if you see them along with candlestick formations, or if they're occurring at major levels of support or resistance, then that is even better. Now, we just went over my 4 favorite indicators, and I kept on saying that if you see them along with candlestick patterns, then that is when you know when to use them. So it's only fitting that we talk about candlestick patterns right now. Candlestick patterns are candlesticks that form in specific ways in order to help us determine what the price will potentially do next. You might have heard some patterns before, such as the hammer, the shooting star, the doji, or any of the other dozens of candlestick patterns that are out there. Now, you could go out and study each and every candlestick pattern, or you could learn the simple rules I'm about to teach you in this video, and that will give you 90% of what you need to know about how to trade candlesticks. First, though, some basic things about candlesticks. Candlestick patterns can be used to spot trend reversals, trend continuation, ranging markets, bullish markets, bearish markets, sideways markets, and most importantly, the general consensus of market participants. Each candle tells a story about the battle between the buyers, or the bulls, and the sellers, or the bears. Candles are your first line of analysis because they're showing what the current market participants are doing in real time. Most indicators use price action to come up with their values. So if you use the candlesticks, which is the price action in real time, you could see things before the indicators print their values. Of course, combining candlestick patterns with indicators could be extremely useful as well. And that's why I showed you indicators. But really, you should look at candlesticks first and use indicators as confluence to your trading thesis, which basically comes down to looking at the candlesticks first, creating a trading thesis based off of that, and then using the indicators as an additional thing to build upon your trading thesis. Now, we already went over how to read candlesticks in the first part of this video, so if you want to refresh your memory, you could rewatch that part. Here, we're going to go into more detail about how to actually use them for trading. So let's start off by going over 3 types of candles. First, you have the candles that are 100% body with no wicks. If you see a red candle like this, it means that the price started out at the highest possible price that it ever was on that particular time frame, and then the sellers just absolutely dominated, drove the price down, and it ended up closing at the low of the candle. That is super bearish because it is showing that the bears are in complete control. Now, the opposite is true for green candles like this. Here, the price started at the lowest price that it was during this entire candle. It then shot all the way up and it closed at the absolute highest price it was during the entire candle. And that means that the bulls completely dominated during the time that this candle was printed. And so typically when this happens, it's extremely bullish. Next up, we have the candles with a long wick pointing out to one side. For this red candle, the price started here. The bulls then put in a really valiant effort to push the price up, but the bears came back in full force, pushed the price all the way back down below the open, and it ended up closing down right here. So most of the time, this is pretty bearish, especially if you see it at the top of an uptrend, because that means that buyers continued to try to buy, but then eventually the sellers came in and said, you know what, I've made enough profit, and they start selling and push the price down. For this green candle here, it means that the price opened right here, and during the time frame of this candle, the bears came in and pushed the price all the way down. However, The bulls ended up coming back, pushing the price all the way back up to above the open, and it ended up closing positively up here. So if that happens, would you say that's bearish or bullish? Hopefully you said bullish. Now, for these long wick candles, sometimes these candles could be a little hard to distinguish whether they're truly long wick candles. A way to objectively categorize them is to draw a fib from the bottom to the top of the green candles and check if the body is fully above the 38.2 level. So for this candle right here, if you take the fib from the bottom of this candle to the top of this candle, you could see that the body is fully above the 38.2. That makes this a truly long wick candle. For this one, however, if you take the Fibonacci from the bottom to the top, you can see that the body actually falls below the 38.2, which means that this is not a true long wick candle. And that is how you can objectively measure whether or not the candle is or is not a long wick candle. For red candles, you take the fib from the top to the bottom, and you make sure that the body of the candle is below the 38.2. You can see that this is the case for this candle right here, which means that this is a true long wick candle. And for this one, we take the fib from the top to the bottom, and you could see the 38.2 is right there, which means that the body of this candle actually rose above it. And because of that, it means that this is not a true long wick candle. So you wouldn't necessarily use the same things that you use for the true long wick candles if you see something like this. And so if you're ever unsure if a candle is truly a long wick candle, you can do this test and see for yourself. Next up, we have candles with long wicks on both sides. For these candles, the bulls and the bears both fought, but none of them won. And because of that, these type of candles represent indecisiveness or indecision in the markets. By the way, candles could also be small, but the smaller the candle is, the more it means that there is indecisiveness in the markets and that the price stayed confined within a small range. So let's go over some examples. See if you could point out the bullish long wick candles on this chart. There are a few, but the best ones to use are the ones that form at the bottom of pullbacks during an uptrend. Here, I drew out the uptrend, and you could see that there is a bullish long wick candle that formed at the bottom of the pullback right here. This was also at the previous resistance. And if you remember, many times the resistance turns into support. So if we didn't know what happened after this candle formed, and we were to take a trade based on this information, we know a few things. We know that the price is an uptrend, so we want to buy at a level of support when the price comes back down during a pullback, and we want to long the market so that we are trading with the trend. Also, we want to trade when we see a candlestick that is a bullish candlestick in that area or in an area of interest, such as the previous resistance, which then turns into support. And we have all of that lining up for us right here. So if we put on a trade where we buy right when the price actually finishes creating this candlestick, and we put on the trade so that we take our profits a little bit above the previous highs, because in uptrends, we know that the price moves past the previous resistances, then we could put on a trade such as this, and our stop could go below the low of that long wick bullish candle, because price shouldn't come back down there if the bulls are really in control. If this was really a bullish candle and the market participants are really stepping up, then the price should not come back down and fall below it. And you could see the price ended up coming up and hitting our targets. And even on that same chart, just a few candles later, the price came back down to the supports and put in another bullish long wick candle right there. So we could put our entry on the candle close right there. We could put our stop loss right underneath the wick, because once again, if this truly is showing that the market participants are bullish and this truly is a bullish long wick candle, the price really shouldn't come back down underneath of it. And because we are trying to continue the trend, the uptrend, that is what is happening right now, we'll put our profits a little bit above the previous highs right there. And just a few candles later, the take profit was hit as the uptrend continued. So what about downtrends? Here we have a clearly downtrending market. And right here, we have a clear bearish long wick candle. And it was occurring after a pullback in a downtrend. So you could see the price created a high, a lower high, and potentially another lower high right here. So we could put on a short trade right here with our stop above the high of this candle, because if this really was a bearish long wick candle and the market participants were really bearish, then the price really should not come back up above the high of this candle. And because we are in a downtrend, we are expecting the price to continue that trend, which means that the supports will be broken. And so we will take our profits slightly below the previous lows. And as you could see here, it ended up working out where the price ended up coming down below the previous lows. The price never came up to our stop loss, and we ended up getting our profits. And here we have another example where we have a very clear downtrend. We have the support right there, and the price was creating a pullback into the previous support area, and then it put in a bearish long wick candle. Not sure if you could actually see, there is a wick that comes up from here to right there. And so this is actually a bearish long wick candle. And if we see what actually happened, you can see that the downtrend continued and we were able to take our profits down here with the continuation of the downtrend below the previous low. And here we have another example. And in this example, we have this bullish engulfing candle, which is this very bullish no wick candle that you could see right here that completely overpowered this candle and actually a lot of the previous candles. And not only did we get this super bullish engulfing no wick full body candle, but you could see that we actually also had a bullish divergence on the RSI, where the RSI created a higher low while the price created a lower low. Now, this setup is actually pretty rare. And as soon as it happened, that was the trigger to go in and trade this pair. So as soon as you see something like this happening with the bullish divergence after a long downtrend, that could potentially mark the end of the downtrend and the move that is about to happen, which you could see happened, and it was absolutely phenomenal. And on the opposite side of that, here we have a bearish divergence with a super long, very little wick or no wick, full body red bearish engulfing candle that happened at the same time where an RSI was printing a bearish divergence on the RSI. So you can see that the price is higher, but the RSI was lower. And not only was there this bearish full body, very little or no wick candle and the bearish divergence in the RSI, but it happened at this key support resistance flip area. So you know that this is very important. And remember what I said before, if the price comes up and flips an area, but then falls right back underneath of it, then that is a huge tell that this was simply a liquidity grab. So we had this area of consolidation. And when this happened, I'm sure a lot of people put their stops right above these three highs. So basically right here is where a lot of people put their stop losses for any short positions that they might have taken. So what happened is that the market makers came in and shot the price up, took out everyone's stops, and then shot the price right back down. And that is a pretty big hint that we're going to continue going down. And of course, in this case, we also had the bearish divergence on the RSI as even more confluence. So we enter into the trade right here and we target the bottom of the range. And as you can see right here, the price did eventually reach the bottom of the range, although for this one, it did take some time. But a winning trade is a winning trade. And now this is that same chart that we just looked at. So this chart is this chart right here, except it's zoomed out just a bit. And you could see that when the price did come back down to the previous support, that there was actually a bullish divergence on the RSI right here and the MACD right here after our original take profit on the short position was hit. And remember what I said about how if there's a bullish divergence on the RSI, that's a big deal. And if there's a bullish divergence on the MACD, that's also a big deal. So if there's a bullish divergence on both the RSI and the MACD while the price is at support, that is a trade I'm going to take 10 out of 10 times. And so this happens, you put on a trade right here, you open it right here, and you target the top of the range right here. And once again, the price ended up bouncing and hitting our take profit for 31% with a 7 risk to reward ratio. Absolutely amazing risk to reward ratio. You would do very well on a trade like this. But like I said, finding a bullish divergence on the RSI is sort of rare. Finding it on the MACD is sort of rare. Finding it on both at the same time, that's even more rare. But that's also why I take those trades every single time that I see them, and they usually work out extremely well. And so with that being said, that's going to be it for the candlestick portion of this video. And now we could get into the chart patterns and how to use them in the markets to better understand the entirety of technical analysis, even more than you already do. So chart patterns are patterns that are created from many candlesticks. Instead of just looking at 1, 2, or 3 candlesticks, which is what you do when you look at candlestick patterns, with chart patterns, you could look at 10, 20, 50, or sometimes even more candles and the patterns that they create when they all come together. And so chart patterns, they could give you indications of possible trend reversals, market sentiment, and also give you possible entries and exits in your trades. Now, there are hundreds of chart patterns, and you could learn each and every one of them if you want. But for me, I only like to use 3 to 5 chart patterns because they show up the most often and have the highest degree of success. And just like with candlestick patterns and indicators, it's best if you use chart patterns at the support and resistance levels to give you the best possible chances of putting on a winning trade. Also, just like how we have objective rules for candlestick patterns, we have objective rules for chart patterns so that there's no confusion when plotting them out. So the top 3 chart patterns I use are the double top and double bottom, the falling and rising wedge, and the head and shoulders and inverse head and shoulders patterns. And we'll start off with the double bottom. The double bottom is a bullish reversal pattern. You could see that the price came down to this area here, popped up, and then came back down again. So it formed a support, which technically it already had because this was the previous resistance, and as resistance turns into support, so it came back down to the previous SR flip area, came back up, then came back down to the previous support, and formed a double bottom right here. Now, when this happens and the price starts to move up again, what you could do is you could put a line at the high that occurred between the first and the second low. And so this line right here is called the neckline. And so in order to classify this chart pattern as an official double bottom, the price needs to break above this neckline after the second bottom is formed. Traders like to take either a long position as soon as the price breaks and closes above the trend line or the neckline, or they will wait until the neckline is broken and then get in on a pullback to the neckline. In this particular case, you could see that the price closed above the neckline and it was still extremely close to the neckline. So here, I would want to get in at exactly right when it closes because it's so close to the neckline and it's above it. So it satisfied the objective data that we needed in order to call this a double bottom. And I would get in and I would put my stop underneath this previous low and I would target the new all-time highs, or at least the previous swing highs, which you could see are right there. And as you could see here, the price came up to our take profit. Now, there are a couple things that I want to point out right here. First off, you could see that the neckline was actually a previous resistance back there. And so because of that, that added a little bit more confluence to the trades. Also, you could see that the price was in an overall uptrend before the price came down, formed this bottom, and then eventually formed the double bottom. So we are trading with the overall trend, which increases our chances that our trade will be right. Also, as I pointed out, the double bottom formed at the previous SR flip area. So this was a resistance, and then it turned into a support right here, and then another support. So this was at a key level. And so now, as far as the objective rules I use for double bottoms, the candle body cannot close below the low of the first bottom. And so as you can see here, none of these lows closed below the lows of the previous or the first bottom. The second rule I have for double bottoms is that the candle body needs to close somewhat close to the first bottom. So here is the candle body, and you can see that it closed fairly close to the first bottom. It's basically at the same level, which is perfect for a double bottom setup. And so if there is only, say, a long wick that comes down to the area, but the body closes well above it, then personally, I don't count that as a double bottom. And now there could be wicks into the area and even past the area. But the important thing is that the body, the actual body, can't close underneath this area. Like it really needs to close at or very close to the previous or the first bottom. And so the wicks could go fairly far below it. And you could even argue that having wicks that fall very far below it and then shoot back up, which is what a wick is, that's actually very bullish and it's good for the double bottom. But you really don't want to see the full body or the candle close below this area. And in that same context, talking about long wicks at this area, if you get a bullish long wick candle like we did right here in that area of interest, that just adds a little bit more confluence to the trade setup. And so that's a double bottom. So what about a double top? The double top is simply an inverse of the double bottom. And that means that the double top is a bearish reversal pattern. Here you could see that the price was in an uptrend, came up, formed the first top, came back down, formed a neckline, and then came back up and formed the second top right here before coming down and breaking below the neckline. And remember that you want to look for chart patterns and candlestick patterns and any other concept within areas of interest. And you could see that this is a great area of interest because this was the previous key resistance / support area right here. And so following the rules for a double top, the candles, they closed within the zone and they did not close above the first top's high, which was right there. And the candles closed very close to where the first top's candles closed as well. And so once we got the break of this neckline, the double top was confirmed and you could enter your trade either right when this happens, or you could wait for a pullback, which you could see happened right there. Now, for this one, because this was a really big red candle and the close was pretty far underneath the neckline, I would not want to enter into a short position after such a big red candle. It's pretty dumb to sell after a big red candle. You want to sell during green candles or when the price is moving up, and you want to buy during red candles when price is moving down, because most likely the price will reverse. Because of that, I would wait to see if the price comes back up to the neckline before I would get into an actual trade. And doing that would give a much better risk to reward ratio. And so specifically, I would wait until the price came back up to the neckline, and then I would go into lower time frames, and I would look for very specific criteria in order to enter into a short position on something like this. And you could see here that the trade ended up working out perfectly, and we would have secured our profits right there. Now, knowing about these chart patterns is vitally important. But if you don't know how to enter and exit your trades, you're missing out on a crucial step in your trading knowledge. So if you want my exact entry and exit tools and techniques that I use to give me pinpoint accuracy on my trades, visit cryptoelite.com, where you will learn all of the advanced trading techniques that I use to get the maximum amount of profit with the lowest amount of risk. And with saying that, let's jump into falling and rising wedges. The falling wedge is a bullish reversal chart pattern. Like everything else, they work best when they occur at support and resistance areas, along with being combined with other technical concepts like candlestick patterns, RSI, MACD, and others. Because the falling wedge is a bullish pattern, it's best to use it when we are in an uptrend on the higher time frames and are coming into an area of interest on a pullback on the lower time frames. The falling wedge occurs when the price makes lower highs and lower lows but the steepness of the lows is less than that of the highs. Taking a look at this chart here, you could see that the resistance line right here was fairly steep. And you could also see that the support line right here, it was getting lower, but not as steep as the resistance line was. This means that the buyers are continuing to step up and there's less and less selling pressure, or there's more and more buying pressure as time goes on. And eventually there's a break of the resistance, which you could see right here, and that confirms the falling wedge pattern, and that is when you would look to enter. In this case, you could enter right here, right after the break of the falling wedge, and you could put your stop back inside of the falling wedge pattern, which would be underneath these wicks back here, which I think is really good because this is a bullish candlestick pattern. So you could combine different things and say, okay, this was a bullish candlestick pattern. The price maybe did a fake breakdown below it, and now that it broke past this resistance line, it should not come back down below here. So that's a good place to put your stops. And because this is a bullish reversal pattern, you could put your take profits at the top of this range. So you can see this is a huge resistance area. So the price will most likely get resisted again and bounce off of this area if it does come back up. And here we go. You could see that the price came all the way up and hit our take profits. And so this was a profitable trade. And here is the important things to know. This time frame is on the hourly time frame. If we go to the 12-hour time frame, you could see why this trade was so good. And so here we're on the 12-hour time frame. And what do you notice? We are actually at a key support area of interest when the falling wedge happened. Now, you can't see the falling wedge on this 12-hour chart, but you can see that the price respected this area multiple times. So what you would do is before this area was even hit, you would have marked out this area on your chart. Then when the price came back down into that area, around that general area, that's when you would look for trading opportunities, such as the falling wedge that I just showed you, in order to enter your trade. So if you saw a falling wedge in the middle of the chart, not anywhere close to the support, then it wouldn't mean anything. You want to use chart patterns and candlestick patterns at key areas of interest, just like this here. By the way, if you're learning something and enjoying this video, be sure to give this video a like right now. Smash that like button for me. You're getting all of this for free. And all you need to do to show your support is tap the like button. And if you're feeling extra spicy, go ahead and subscribe to the channel so that you don't miss out on any of the trading and investing content that you'll be getting if you subscribe. And if you want even more free content and want to know my thoughts on the crypto markets 24/7, there is a link to my free Discord group in the description below, and I highly recommend you check that out. Now, going back to the chart patterns, we just went over the falling wedge. So now let's go over the rising wedge. The rising wedge is the inverse or the opposite of the falling wedge, and it looks like this. You could see that this happened at a key resistance area, which is so important, and the price broke below the support. So when that happened, that confirmed this rising wedge pattern. And as you could see, the price ended up falling and it actually fell pretty drastically. So now let's go over the head and shoulders pattern. The head and shoulders pattern is one of my favorite patterns for a few reasons. The first is that it tends to work out quite often. And the second is that it's pretty easy to spot. And the third is that it usually provides some really good risk-reward ratios. Here's the deal though. I use the head and shoulders pattern a bit different than most people. And this is because I believe that the standard way of using the head and shoulders pattern is not the most optimal. It does not provide the greatest risk-reward, and it should only be used in very limited select situations. So let's go into the head and shoulders pattern, and I'll show you how I like to use it. So first off, the head and shoulders pattern is a chart pattern that prints what looks like a left shoulder, a head, and a right shoulder. The support area, which you can see here, this is called the neckline. And traditionally, the way the head and shoulders pattern works is, or the way that's traded, is that once the neckline breaks, you enter a short position and then aim to buy back lower. And you could see, even in this example here, if you did do that, if you did sell right here, or even wait for it to retrace a little bit to back to the neckline and then sell and then buy back lower, yeah, it would have worked out. However, two things to notice here are that before the price did that, it came back and closed above the neckline. And also, even though the price that it fell to was decent, there was an opportunity to make a lot more if you entered the short position at the right shoulder instead of once it broke the neckline. And the reason why the price closing back above the neckline, like right here and even right here, is so problematic is because that puts the price action back above the support. And as a rule that I follow and that I think is a really good one is to never short when the price is at the support and above the support. It makes sense to sell or to short at a resistance level if, for instance, it was a support and then the price fell underneath of the support, just like how it did here. Yeah, if the price comes back up to the previous support turned into resistance, then you would want to sell or go short. But what happens in these situations where the price puts in a bearish candle, but then it actually rises up a little bit more, then rises up a little bit more and goes higher and higher? This right here is where you're most likely going to get stopped out if you put on a short position right here. It would take a lot of mental fortitude to not close out your position once you saw 3 green candles close above the support. And even if you decided to wait, you'd probably decide to buy back and close out your short position at break even once the price came back down to the previous support resistance, because at this point the price is above the support, and typically when the price comes back down to support areas, just like how it did here, that's when you want to buy it. It would have been so much easier if the price simply came back up to the neckline, you shorted, and then the price fell back down and it never closed back above the neckline. Also, a lot of people probably did short the position or short the market right here. And then as the price moved down, they probably took their stops and moved their stops a little bit further down, which ended up getting stopped out on this really big candle right here that went back above this previous close. So yeah, there was a lot of areas during this time period that were extremely tricky. It would have been extremely tricky unless you simply put on your short position right here, put your stop up here, and never touched it and never looked at it. So if you did that, or if you could do that, congratulations. That is incredible. Just wanted to give this as a heads up. Now, if you were to look for shorting opportunities here at the right shoulder or within the right shoulder, you could see that the risk to reward is way greater than trying to short at the support. And if we go into a lower time frame, you could see that we got a bearish long wick candle within the resistance area of interest that presented a perfect shorting opportunity right here. So you could see the left shoulder formed right there. And what you want to do is create a rectangle and extend it out, because typically the right shoulder is pretty close, either at the same spot, a little bit above it, such as this one, or a little bit below it. And you want to look for shorting opportunities in this area right here in the right shoulder. And so if you did that, and then you went into the lower time frame, such as this, and you saw this extremely bearish long wick candle right here, then you could have entered into a short position at the close, put your stop right here, and you could have rode this entire wave down. By the way, if you want every entry trigger that I use in my trading, along with where and how I place my stops and all of this, I can't fit all of that into this video, but it is available at cryptoelite.com. I will be making more videos in the future for YouTube, but right now everything is available there. So if you want it right now, you could go there. So the head and shoulders pattern is a bearish chart pattern. Now, there's also a bullish version, which is called the inverse head and shoulders pattern. And this one is the head and shoulders pattern flipped. And I actually like this pattern way more than the bearish head and shoulders pattern because, one, I'm a bull and I like when things go up. And two, you could usually make more money because things tend to go up more percentage-wise than when they go down. And that holds especially true on patterns like these. And so here you could see what could be described as a left shoulder, a head, and a right shoulder. And then this right here is what's known as the neckline for the inverse head and shoulders. And before this neckline was even broken, it's already bullish because we have the support area right here, and the price basically came back up and reclaimed that support area. You could say that it's slightly below it, so it's not a 100% reclaim. And you could say that this is the support and it's been bouncing off the resistance until this candle actually formed. But there is an argument to say that the price came down and the bears could not keep control, and the bulls came in and shot the price all the way back up. And that in and of itself is extremely bullish. So that's one way that you could be looking at this. Or you could be using it the standard way that people use the inverse head and shoulders, which is to wait until there is a break of the neckline, and then you get in on that bullish momentum candle. But typically when something drops and then reclaims the previous support almost immediately, that's really bullish. Now, normally for the inverse head and shoulders pattern, like I mentioned, you wait for the neckline to be broken before you enter. But if you could see a bullish signal at the area where the right shoulder is, that could also be an area to long for potentially greater gains. And so if we go into the lower time frames, we could see that it actually printed a bullish long wick candle right here, right at the right shoulder before absolutely sending with zero pullbacks. So I would love to be able to tell you that this is all you need in order to be a profitable trader, quit your job, make millions of dollars, and do everything you want. But unfortunately, that's not the case. Just understanding technical analysis isn't enough. And although this video had a ton of information, to be a consistently profitable trader, you need to know about mindset, market cycles, fundamentals, trade management, and more. Obviously, I can't fit everything into just one video for you. Fortunately though, we do have some more space available in our mentorship program. So if you would like to learn the exact combination of technical and fundamental strategies that I use when I look at the markets, or you would like to see the possible trade setups that I'm looking to take each and every week in the crypto market, and you want to speed up your journey into becoming a profitable trader, then there's a link below to a very discounted price on the Crypto Elite course and another for the Crypto Elite VIP Discord group. And I know that since you just watched this entire video, you're trying to figure out this trading thing and take it seriously. So in the description, you'll find two separate links, one for the course and one for the Discord group, both of which are heavily discounted from the original price. And that is one way of saying thank you for watching this entire video through. And if not, that is totally okay too. You now have a very solid foundation of technical analysis. And if you watch my other videos, plus the ones I'm coming out with in the future, you will get a really solid foundation for trading psychology, fundamental analysis, and even more specific trading strategies. So whether you decide to buy the course, join the VIP group, or simply keep watching the free content, the important thing is that you continue to analyze the charts, come up with strategies, learn and implement proper risk management, and make sure that your mental game is on point. And I know that if you do these things and you stick with it for long enough and you have that growth-oriented mindset, make sure your mistakes turn into learning opportunities, put in the time, and you actually give it a real go, that you too could become successful in crypto and make those life-changing gains that you hear about all the time in the crypto space. And so with that, be sure to smash that like button and subscribe to the channel if you have not done already. Remember, you're awesome, stay awesome, and I'll see you in the next video.